The Central Bank of Kenya, or CBK, has made a significant decision. It has announced a new directive to increase the core capital requirements for banks. This requirement will jump from 1 billion Kenyan shillings to 10 billion Kenyan shillings. That's a tenfold increase. This move is intended to strengthen the Kenyan financial sector. The CBK aims to create a banking sector with fewer, larger institutions. These institutions will be better equipped to handle large financial transactions. They will also be better prepared to manage emerging risks, including challenges posed by information and communication technology and climate change. This directive has sparked debate within the financial sector. Some experts applaud the move, believing it will lead to a more resilient financial system. Others express concern about the potential impact on smaller banks. They worry that these banks may struggle to meet the new requirements, which could lead to mergers, acquisitions, or even closures. The CBK's directive is a significant development in the Kenyan financial landscape. It is crucial to understand the rationale behind this policy shift. It is also important to consider its potential implications for different stakeholders, including banks, businesses, and the overall economy. This is not the first time Kenya has seen an increase in core capital requirements for banks. In the past, the CBK has implemented similar policies to bolster the financial sector. One such instance led to the merger of I&M Bank and Giro Bank. This merger was a direct result of the previous increase in core capital requirements to 1 billion Kenyan shillings. The current directive, however, represents a much larger leap. It is a tenfold increase from the previous requirement. This significant jump has led to a mixed bag of reactions. Some see it as a necessary step to ensure the stability and resilience of the banking sector. Others worry about the potential negative consequences, especially for smaller banks. The CBK has given banks 3 years to comply with the new requirement. This time frame is intended to allow banks sufficient time to adjust and adapt. However, the magnitude of the increase has raised concerns about potential disruptions in the financial market. Niche banks play a vital role in Kenya's financial ecosystem. They often cater to specific markets that larger banks tend to overlook. These markets include small businesses, rural communities, and specialized industries. Niche banks provide personalized services and financial products tailored to the unique needs of their clientele. These banks are often at the forefront of promoting financial inclusion. They provide access to financial services for individuals and businesses that may not meet the criteria for traditional banking services. This role is crucial for driving economic growth and reducing poverty. The new directive, however, poses a significant challenge to these niche banks. Meeting the increased capital requirements may prove difficult. It could force them to merge with larger institutions, potentially diluting their specialized services and focus on financial inclusion. Kenya is not the first African nation to implement such a policy. Both South Africa and Egypt have undertaken similar reforms in their banking sectors. These reforms offer valuable lessons for Kenya as it navigates this new directive. South Africa adopted a phased approach to increasing core capital requirements. This gradual implementation gave banks ample time to adjust and adapt. Smaller banks were not forced out of the market. Instead, they were able to transform into niche players, operating under a tiered banking system with differentiated licenses. Egypt's approach involved active government participation. The government played a key role in recapitalizing state-owned banks. It also facilitated mergers for private institutions. This proactive approach helped to minimize market shocks. Similar to South Africa, Egypt encouraged smaller banks to specialize rather than exit the market. These examples demonstrate that there are alternative paths to strengthening the banking sector. Kenya can learn from these experiences to implement the new directive in a way that minimizes negative consequences. While the intention behind the CBK's directive is sound, A hasty implementation, without carefully considering the potential risks, could have unintended negative consequences. One of the most significant risks is the potential for job losses. Smaller banks forced to close or merge may have to let go of employees. Mergers often lead to redundancies. Closures mean fewer job opportunities in the banking sector. This could exacerbate unemployment rates. Another risk is the potential impact on financial inclusion. Larger banks may not be equipped or inclined to serve the same clientele as smaller niche banks. This could leave rural communities, SMEs, and specialized markets without access to tailored financial services. Furthermore, consolidating the banking sector into a few large players could stifle competition. Reduced competition could lead to higher fees for banking services and a decrease in innovation. This could negatively impact consumers and businesses alike. Section 6. Striking a balance, a roadmap for success. To mitigate the risks and ensure the successful implementation of the new core capital requirements, a balanced approach is crucial. Several recommendations can help achieve this balance. First, the CBK should consider extending the timeline for compliance beyond the initial 3 years. This would give banks, especially smaller ones, more time to strategize, raise capital, and adapt to the new requirements. Second, introducing a tiered licensing system could allow smaller banks to operate with lower core capital requirements. This would allow them to continue providing their specialized services without facing undue pressure to merge or close. Third, the government could play a more active role in supporting smaller banks. This support could come in the form of financial assistance, technical expertise, or facilitating partnerships. Section 7 SMEs, navigating the shifting sands. Small and medium enterprises, or SMEs, form the backbone of the Kenyan economy. They are vital for job creation, innovation, and economic growth. Access to credit is crucial for SMEs to thrive and expand. However, Kenyan banks have increasingly favored investing in government bonds over lending to businesses and individuals. This trend poses a significant challenge for SMEs seeking access to credit. Government bonds offer low-risk, high-return investments, making them more attractive to banks than lending, which carries a higher risk of default. The new core capital requirements, if implemented strategically, could potentially incentivize banks to shift their focus back to lending, particularly to SMEs. With larger capital bases, banks would have a greater capacity to lend. Section 8. A call for inclusivity and sustainable growth. The Kenyan banking sector is at a crossroads. The CBK's directive to increase core capital requirements has the potential to strengthen the financial system. However, it is crucial to remember that a strong financial system is not solely defined by the size of its institutions. True strength lies in a financial system that is inclusive, competitive, and fosters sustainable growth. A system that serves all segments of society, from large corporations to small businesses, from urban centers to rural communities. As we move forward, let us remember the principles of financial inclusion, responsible lending, and equitable access to financial services. Section 9. Conclusion. A stronger Kenya for all. The road ahead requires careful consideration, collaboration, and a commitment to finding solutions that benefit all stakeholders. It requires striking a balance between strengthening the financial system and ensuring that it remains inclusive and supportive of the engines of economic growth, particularly SMEs. Let us work together to build a stronger, more resilient, and inclusive financial sector that benefits all Kenyans. Let us strive to create a Kenya where everyone has the opportunity to prosper and contribute to our collective success.